Hello. Hello, everyone. Hello. This is Charlie Tian. I'm the founder and CEO of Guru Focus. And every month on the first Wednesday at 1 p.m. Central Time, I'm here to talk to you. Yeah, let me know where you are. I already see Michael is saying he's from Switzerland. Welcome, Michael. Hi. Yeah, tell me where you are. I'm based in Plano, Texas, which is actually North Dallas area. And we are now in spring, and trees are becoming green again. The flowers, lots of flowers, and the weather is actually quite pleasant. Although it usually rains quite a bit at this time. Yes, glad to see quite some familiar names again, and welcome, welcome. Hope to see you again next time, all the time, every time. Okay. Um, Today I want to talk more about valuation. About we got lots of feedbacks on different valuation methods that's available on gurufocus.com. And before that, I want to talk about the market valuation first. We know that the stock market had a difficult March since we had Trump second term. The market has been lots of uncertainties, and the market was down some from the peak. At one time, it was down more than 10%. And let's take a look at the market valuations. Let me share my screen here. Yeah, this is my screen. You should be able to see my screen from on the channel. And as always, feel free to ask me questions. And I love to hear from you, and I will do my best to answer any questions you may have. And the first thing I want to share, as I said, is the market valuation. You can see that on the homepage. I'm sharing the homepage of gurufocus.com. What you see might be different from what I see here because this page is fully customizable. And you can always customize it by clicking here, adding widgets, and you can create another view, have multiple homepages, and set different ones as default. And I'm talking about this ST500 Guru Focus valuation. And if I expand the page out, you can see that this is a full screen market valuation page. The market was very overvalued at here just about 2 months ago. The market was very overvalued. And then it was down about 10% from the peak. And it was still about 10% overvalued relative to our fair value estimates. And now it's about 10%. It recovered some, but now it's about 10% overvalued. It's certainly better. I've seen some stocks that's more reasonable now. The valuation is more reasonable, and I did also observed some insider activity that's picking up slightly. If you look at here, this chart, this is the insider activity. The green bars are the ratios of the insider buys to sells, and this blue line is ST500. This data is from 2004. You can see that whenever we have very high green bars like here or here, the insiders were buying a lot. And coincidentally, you can see that the market is usually actually low, and usually after some declines like this one in 2008, we had a market crash, but insiders were buying like crazy. Then 2012, they were buying. 2016, then there was I think this was the Ebola crisis or something. I think the market was down about 10%. The insiders recognized it quickly and buying. Also, 2020 here, the pandemic, the market was down 30 something percent in 1 month, less than 1 month. But insiders, they know how to do it, so they buy a lot. And lately, we observed some insider activities picking up as the market went down, but not that much. I want to talk about this. I want to emphasize this. I don't think I can emphasize enough. Whenever you're scared due to market crash, always check out this chart, the insider trend chart. And they will tell you what to do. They will show you what to do actually by what they are doing. And it's, of course, you can put it on homepage. It's also linked under Insider Trends page. It's under Insider Trends page. And here, it's actually the chart I showed is exactly this chart. It's an insider buy-sell ratio. Green bars are insider buy-sell ratio, and the blue line SP 500. We added a red line, which is 3 months average buy-sell activity indications. And then here you can see the CEOs, the CFOs, they're actually behaving similarly. And then here, lower parts of the web page shows different sectors. You can see the financial sectors. When they buy, and usually they buy, the insiders, the executives, they buy usually at the bottom of the market, and they don't buy much when the market is high. And overall, aggregated, the performance has been good. And it works for almost every sector. It's even energy sector. You can see that during the pandemic, we know that the oil price went to negative, but the oil companies that were buying a lot, and then the market recovered very nicely, and they were rewarded quickly. I think at least 3 times in 2 years, 3 years of time frame. So it works for every sector also. Now take a look at this when you're uncertain with some sectors, or in general, if you're scared by the market. Yeah, any questions regarding to this? And feel free to ask. I will be happy to answer them, to address all the questions you may have. And otherwise, we will come to the evaluation page. We'll check out the valuations. And also, if you want to give me any stocks, we can take a look. And I will use the stocks you give as an example to show the evaluation tools we have. And okay, I'll just pick a random one, Monster Beverage. And let's take a look at Let's look at DCF first. And GuruFolks provides many valuation methods, but let's take a look at DCF, because DCF is the most well-known one, most recognized, most well-known one. But before you use DCF, you should be aware that DCF method, DCF valuation actually has lots of limitations. And DCF, it works well for the companies that has predictable earnings and predictable cash flows. It works that way. It does not work very well for cyclical companies or the company that's very new and does not have lots of history, because with DCF module, DCF calculation, we have a lot of predictions. They are actually listed here, assumptions. We have lots of assumptions. They are listed here. For example, the discount rate. What is a value? What is a reasonable discount rate? We use 6% above the current 10-year rate. So that's why it's 11%. But if interest rate changes, it will change. And also the starting point, you can use earning per share, you can use free cash flow per share, you can use adjusted dividend per share. We defaulted to earnings per share. The reason is because we did quite some studies before. We found that the price change of the stocks are more correlated to the earning per share instead of free cash flow per share or dividend per share. That's why we used earning per share here and as default. Then you have to have assumptions as a growth rate, the future growth rate next 10 years, and also a terminal growth rate. It's a two-stage DCF. We assume the first stage is 10 years, and growth rate here default to the same growth rate as 10 years growth as the previous 10 years growth rate. Then for the next, for the 10 years after that, we default to 4%. This can be too low or too high. So if you adjust any of the parameters, you can see that the valuation will change. In Monster Beverages case, and currently it shows the market, this stock is overvalued because based on all the assumptions we have, it seems to be overvalued. And then we have this reverse DCF model. And reverse DCF model is to check at the current stock prices what kind of growth you need to justify the current stock prices. So that's why we have this reverse DCF model. And you can see that again in Monster Beverages case, the stock has been growing 14.9%, but it needs to grow 20.29% to justify its current price. So again, it shows that the future growth most likely will not meet the expectations. So that's why the stock price is again overvalued as mirrored by the reverse DCF. And if you want to learn more about DCF, we have tutorials here. Actually, we have, if you click on that, we have the articles we wrote in the past and about DCF, about different changes we've made, and about reverse DCF, about the Skinner related to it. We also have a video we recorded before. And yeah, use those to understand more. Again, the most important thing is that you need to understand that DCF model is actually very limited, and the stock, the company earnings, operations needs to be very predictable for you to use DCF, and you need to understand that there are lots of assumptions that are used in the DCF model. You need to check if all these assumptions work for the companies you're studying. And yeah, that's about DCF model. And again, I mentioned that we provide lots of valuation methods, which is actually listed under under the stock summary tab here. And you can see that here we have something called a valuation charts, which lists all the different valuation methods. And see that we have the GF value methods, which is one I like the most, and I think it works the best. Also, we have different models developed by different people, like earnings power value. This model was developed by Professor Greenwald of Columbia University. I think he's retired already. He gave us seminars several times before. And the net current asset value, which is a valuation that's used by Ben Graham, tangible book. It's a book value. Projected this free cash flow model. It's a model actually developed by us based on a suggestion of a user many years ago. And the median PS value is based on the median, assuming that the PS ratio will be the same. Should be the fair value stay the same. The median PS, the current fair median PS should be the same as a 10 years median PS. Gives different valuation. Graham number is also Ben Graham's valuation method. And Peter Lynch value, it's based on the assumption that the P ratio should be equal to the growth rate. So if the company is growing 20% a year, so a reasonable P should be 20. That's a model that Peter Lynch used. But frankly, the market has been much more valued much higher than Peter Lynch's time. Of course, it's related to the interest rate and lots of other factors. And also DCF model, free cash flow based and earnings based. So we have lots of valuation methods. And we Again, the one I think I personally like the most, and I think the most reasonable one is the GF value methods. And we got lots of questions how GF value methods were developed. And it's actually, first of all, it was based on our observations. Then we did a lot of study. We was calculating the correlation of stock price changes to add a lot of parameters. Actually, I think it's summarized under the valuation tab, which we released this year. The valuation tab, we study the correlation of stock prices versus a lot of parameters, like here, revenue, book value, and the earnings per share, and free cash flow per share. We study all these correlations. We found that in most cases the stock price actually has higher correlation with revenue, and then we use a parameter that's mostly related to the stock prices, and to predict the future stock, to calculate the reasonable valuation and to predict future valuation, assuming this kind of correlation will stay the same. So that's why for a monster beverage, currently we think it's slightly undervalued or fair valued here, and the future valuation trends is like that. And then if we take a look at another company like Fastener. And by the way, all these stocks I own in different ways, either in my personal account or in other management I have. And you can see that Fastener, and yeah, the stock is modestly overvalued because it's now above the fair value line. Okay, Oscar is asking me take a look at EVVTY. Let's take a look. EVVTY evolution. I think someone asked me this before. Yeah, asked me about this company before. It's from Sweden. A company from Sweden. What does it do? I forgot. Let's take a look. The company is a provider of casino system, slot casino system. Okay, yeah. It's a provide casino system. Okay, it's not something really my favorite industry. The stock went down quite a lot. Yeah, I think seems to be undervalued according to our model. And let's take a look at the valuation page. Yeah, it's significantly undervalued according to our model. If we look at the correlation, seems to be undervalued by every measure. But the correlation has not been very strong. The closest one is price to book value correlation. The correlation ratio is only 64%, not that very strong. And the parameter does look very good. The financial strength and the profitability, yeah, it's a casino. You can imagine that the profitability is good. I don't see any. The growth is good too. Seems like the profit margin is high, of course. Growth might be slowing down. I don't know enough about this company, but if I just look at the numbers, seems to be very good. But it's a casino business, you know. It has other risk, such as such as uh, regulatory risk, right? It's a casino, and I don't know enough about it, but that's what I think. I don't know why the stock comes down. It seems to be down ever since it like in last since pandemic, and it has always been going down. But prediction looks good too. I I don't know, and you may want to study it more. Okay, let me look at other questions. If Focus is amazing universal language translation. Well, yeah, we got some requests about language translation. Not sure how to implement it, and we can certainly take a look. How do you use 3 months average red line to guide investment decisions? I'm not sure. Sprint leaves. I'm not sure what you're referring to. The average 3 months average red line. If you mean the technical guidelines, I don't really use it. Okay. Adam provided feedback and NVIDIA. Okay. Of course, NVIDIA is everyone's was excited about NVIDIA. This year it has not been doing really well. It's down, but down 20%. I think the expectation was high. Certainly, the expectation was really high. NVIDIA has been growing tremendously, very quickly. 3-year growth rate 70%. Where can you find companies that grow 70% every year with huge profit margins? But in technology sector, it's always like that. When it's going up very fast, but the competition can also be a factor. Sometimes the expectation is very high. In this case, the expectation was really high, so then no growth will be fast enough to meet the expectations. So and this year, of course, we know that's the DeepSeek from China, which seems to be saying that we don't need that much advanced chips from NVIDIA. So that certainly burst a bubble some, I think. But in general, I think the company is certainly very competitive relative to other players in the market, and valuation seems to be reasonable or lower. But if you look at P ratio, which is not low, the expected growth is still very high. And I will say that you may want to be cautious. I own some of it. I do. I never sold. Actually, I didn't sell. And but needs to be cautious. Lower the expectations. That's what I think. Why does this keep happening? Mostly the change has not been added to the change log. Okay, yeah, we need to add to change log. I will certainly let our developers know. Sometimes they say, why do random things seems to break? It's either or update during the day. Daniel, I think I agree it happens sometimes we got attacks from internet attacks on our servers. That may slow down the servers. But to trust me, we always work on it, try to make it better. We certainly don't want to break anything. We work on it all the time to make it better. All our intention is to make it better, to make it faster, to make it more stable. To in the meantime to add features, because we do get a lot of requests from the users to add different features, to make changes. We don't always make changes, but we try to add all the features requested by users. When you make changes and add features, sometimes it's software, and it can have bugs. And but trust me, we always try to make it better. And but still, sometimes things happen. Okay, let me take a look at OLED. I'm not sure what does this company do. Universal display, yeah, looks like business description. Let's take a look. What does this company do? Okay, organic light emitting diode. Okay, that's why. And technology used for mobile phones, tablet. Okay, it makes diodes and organic. It's organic light emitting. So it's something new for me. And I only know the LED yearly. The LED is from semiconductors. I'm not sure it can be from organic. Yeah, but it's new technology. With new technology, there are always risks and always fierce competitions. And the financial strength is good. Profitability seems to be good. Future growth seems to be not bad. And stock is kind of reasonably valued. But with technology company, you always need to be careful. Need to check the competition and if they're always innovating, investing in new technologies, new to beat the competition. But yeah, the company does have lots of cash and almost no debt. The growth is impressive and the profit margin is high. And yeah, I don't see very many. I don't see any warning signs, but you do need to look into the competitions and if the company is investing enough into new technology. That's that's from that's always the thing with technology sector because things change fast in technology sector. Okay, Tesla. Today we know that Tesla had per sales data today released. I think the lowest sales in 3 years. And I never bought Tesla personally, and it's not my type of stock. Just it has so much uncertainties, and yeah, Elon Musk, of course, he's an able person, a very capable person, um, but I don't like the way he has been doing with politics. I don't invest in Tesla. It's personal preference. I'm not. Okay. Let me look at other things. Gold. Brian's talking about gold. Gold is a commodity. It's not. I personally bought gold last year. I think I mentioned it since last year. Yeah, I bought some gold because I feel that the market is overvalued and there's so much uncertainties with the markets. That's why I bought some gold. The gold has been doing really well. About the trend of the gold, I think it will still go up some, but now it's close to the highest price. Even adjust for inflation, it's getting close. So the risk is there. Needs to be cautious. Okay, Rafa is asking UTHR. Let's take a look. UTHR. United Therapeutics. Okay, it's biotech company and usually they make drugs, I think. GF score is good. GF score is very good. The financial strength and profitability rank is all good. I think it looks pretty good. I would say it looks not bad. The valuation seems to be reasonable also. And of course, I don't know their pipelines. I don't know exactly what they make, but yeah, but seems to be makes high blood pressure. Yeah, I think the numbers looks good. That's my comment. Okay, Abraham's asking if company stock is going to go down, would it be result per leadership decision or market is just too strong for them, or the company cannot handle the competition, or is it not enough? It can be all of them. It's really in different cases. Okay, Crocs. Crocs. Yeah, we all know. Remember that's the shoes, ugly shoes they're making. They are making. Okay, the 10-year actually market return was very good. 800%, much higher than the general market, but it has been very volatile. I think the company went through some different phases of problems. I didn't follow it. Financial strength is not bad. The profitability rank is not bad. The current valuation is actually good. So I think seems to be risk seems to be relatively low. The company is not growing. Seems to be growth seems to be a problem. The good thing is that company is paying down debt. That's a good thing. And yeah, seems to be quite some positive things for the company. How about Google? Okay. I saw someone is asking me about Google. Okay. Carlos about Google. By the way, thank you. Carlos. Google. Okay. Google. I own it. Has owned it for quite some long time. Quite long time. I am actually somewhat concerned by Google. We all know that the AI thing, AI tools getting much more advanced. Whenever we ask something, it appears directly give us an answer, and it can be on different tools, on OpenAI, on DeepSeek, on Google itself, or on Pilot, Microsoft tool Pilot. I think Google is facing some strong headwind. The big stage, look at Google's earnings or revenue breakdowns. Mostly, it's still, I think, we have it income statement breakdown. It's still from the search, mostly from the search. So Google services and Google Clouds, mostly from search, still the revenue, earnings. So yeah, Google will have some pressure, I believe. It will have some pressure on the growth, on its biggest market, biggest revenue share, which is the search related. So, but on the other hand, Google does have lots of cash and has been very strong. So the growth may slow down some due to the competition, and yeah, we do need to observe it. If you look at past 10 years, the revenue growth was 20%, but the analysts are predicting just half of that growth in the next 3-5 years. So it does face some headwind. If I check myself, I'm not using Google as often as I was before. And I'm not sure everyone else, but I think that's a general trend. Okay. Okay, thank you, Brad, for the comment. What does your software show NVIDIA as a value trap? Okay, let's come to this. I showed NVIDIA, and it does show as a value trap. And we check value trap as because we track a few factors. We check not just just simple how much cash, how much debt they have. We check like interest coverage. We check their Petrosky F score. If you don't know what that is, in general, it's calculating the future trend, the current trend of the business. If it's above 7, it's good. If it's below 3, it's bad. If it's below 3, it means things are not going well. So we'll list it as a value trap. An ultimate Z-score measures the financial situation of the company. If it's in the green area, it's safe. If it's in distressed area, we'll mark this as value trap. But in Google's case, there's a Binish M score. In NVIDIA's case, yeah, it studies the Binish M score. It studies the numbers of the company to see everything if it's consistent, if it's self-consistent, if it makes sense. So maybe in NVIDIA's case, they find something which looks suspicious. So that's why it's marketed as manipulator. That's the reason we put NVIDIA as value trap. It does not mean that you cannot use it. You cannot invest in it. You need to look into it, dive into it to see exactly what's going on, and it work as a value as a warning sign for you. So study it. If everything's still fine, you don't have to, you understand deep enough. If everything is still fine, then you can still invest in it. It does not mean that you cannot invest in it. It's just that we provide warning here for you to study. Okay. And what are the criteria for rating a stock as a possible value? Okay, I just explained Bill Lam. I just explained. What's the likelihood that a backtested results such as two things will be replicated in the future? Is it advisable to rely entirely on these backtesting outcomes? I don't think you should entirely rely on backtesting outcomes. You should understand your strategy first. What kind of stock you're looking for? You should understand your strategy, and after you understand your strategy, then you will take a look at the backtesting results, and you also need to understand that it will not replicate it completely, and due to different market condition will never be the same. But in my opinion, a good company, a company that performed well over long term, are more likely to continue to do well in the future. Of course, in investing, we said that past performance is not a guarantee of future performance. But past performance is a good indicator of the quality of the business, and that's why we have all this predictability rank. We have that, which measures the performance consistency of the business before, and so if a company does well in the past for long term, yeah, most likely it will continue to do well for some time in the future, unless the business landscape completely change. Okay, I'm sorry. Okay, gold, and let's take a look at gold again. So maybe you're talking about this barric gold. Okay, I made sense. I thought you were talking about gold itself. Okay, we know that gold price is all-time high, all-time high now. But I never bought gold mining stocks. And I always remember that a movie I watched, I think it's called Gold Mine, something like that. And also I read an article and I cannot forget. I think in that article it says one sentence. It says a gold mine is a liar with a hole in the ground. So a gold mine is a liar with a hole in the ground. So I'm always skeptical in investing gold mining stocks. So I never bought any. And I remember years ago, one of our gurus, Arnold Vandenberg, he bought lots of gold mining stocks, and his thesis was that inflation would be high, and because U.S. government is borrowing so much, so the inflation will be high, and gold mining stocks will do well. And yeah, he was right on the inflation, but the gold mining stock actually never did well in his case. And he as he predicted. And so I think the industry is very complex, and so it's heavy, it's capital investment heavy, and lots of dirty work. I just don't like the industry, so I never invest in it. I bought gold, but not gold stocks. That's just my opinion. Okay, let's take a look more. Toll Brothers, Toll Home Builders. No, I'm sorry. Okay. TOLL. It's a ETF. We don't talk about ETFs. I don't know. I don't know about enough about ETFs, about that ETF. So I saw you talk about Cole Brothers. PayPal. Okay, PayPal. Yeah, during pandemic, it did well, like lots of internet companies, and stock has not been doing really well. This year doing poorly. Um, I'm actually always puzzled by PayPal. The business seems to be good. We have PayPal account. The growth seems to be good. If you look at the revenue, the growth seems to be good. But margin, the problem is that it seems like the margin has been declining. If you look at the chart, look at the margin chart. If you look at the margin and the operating margin, I think that's a good indication of the business. Average. Okay, I'm looking at the yeah margin. I was actually not. Margin seems to be stable. Yeah, margin seems to be stable. The business is growing pretty well, but I don't know why the stock has not been doing well. And actually, I'm not sure why the stock is not doing well. The business has been doing well. The valuation seems to be reasonable now, but the stock has not been doing well. I know that there are quite some competitions from different players in this payment industry, but PayPal has not been doing well. I'm not sure why. Okay, NVO. NVO is a stock that we discussed before, and this year it has not been doing well either. The valuation seems to be pretty good, I would say. Valuation is good. Excuse me. Valuation is good, and of course it's a drug company. The key for drug company is that you need to have strong pipelines. So that might be the reason why NVO is not doing well. There are competitions on the weight loss drugs, and I remember reading an article saying that NVO has the effect of their drug was not as good as it expected. That might be a reason. Okay, about Comcast. Yeah, the thing, if I just look at this Comcast, I feel it's not for me. The reason is because of growth, and growth has been not high enough to me. I expect that company can at least grow like 10% with the revenue, with their earnings, especially revenue can grow at least 10%. And Comcast is not one of those companies. Future growth seems to be about 8%. The prediction. So I think the growth is not high enough. Seems to be as a business, the industry is like flattening. The revenue is flattening. Not much growth seems to be. So it's something that I don't like. Although the valuation might be low, I rather have a growing company at a relatively higher valuation than a company that's not growing much. Okay, booking. Rafael talk about booking. BKNE, BKNG, booking. Okay, I think this was it's one time a very hot stock. Okay, the margin you're seeing the margin is negative. You're seeing that the margin safety is okay. Margin safety is negative 81%. Probably, yeah, you're talking about this one. As I said, I discussed the DCF before. yeah, with DCF, there are lots of assumptions. You need to be careful with that. Especially, I can see that we're using the growth rate about 7.7%, but the last 5 years, booking was growing 50%. Last 3 years, booking was growing about 60%. So maybe now it now shows low margin of safety is because growth rate assumption is too low. Yeah, that's what I said at the beginning. When you use DCF valuation, you need to be careful with the growth rate. For instance, if I change to 20%, can see that now the stock is 20% margin of safety. So it depends on a lot of assumptions here. That's with the company. And we, with our method, GF valuation method, that is mostly, that factor is mostly removed. So, and GF value is showing it's more reasonably valued at this point. Okay, Frederico, hello. Nice to hear you from you again. Nice to see you again. Okay, about Bitcoin, I know nothing about Bitcoin, so never invested in it. And sorry, I cannot answer your question. Hunter, what do I think about ENVA? Let's take a look. Innova International. Okay, I never heard about this company, but let's take a look what it does. Providing online financial services, including short-term consumer loans, line of credits, and installment loans to customers mainly in US and Brazil. Consumer, okay, credit online. Okay, to provide, seems to be a financial loan company. It's different from the cash advanced cash company I looked before. Okay, and yeah, seems to be the growth seems to be quite fast for this company. The valuation seems to be okay. Yeah, overvalued. Growth is fast, and it's a financial company, so usually the financial strength is not very good. Yeah, Altman Z-score. I think you need to take a look at Altman Z-score. It's so the financial situation. Yeah, to make sure that it does not have lots of bad loans, especially if we have an economic recession. If will the company can be able to go through recessions if there are lots of bad loans with the consumer loans, then the earnings, the book value, everything will be destroyed. So yeah, that's something you need to look into for finance for this kind of company, the loan quality. But the growth seems to be good, so I think it's worth looking into. Okay. Lulu. Okay, let's take a look at Lulu. Lulu was down, I think, 14% or something like yesterday. Has not been doing well recent years, last few years. The main reason, of course, we all know that the growth is slowing down for Lulu. Yeah, for a growth stock, for a fast growing company, usually that's what happens. It has been growing very fast, but then it's not growing fast enough. The market will punish the stock. I think that's what happened for Lulu. Yeah, the future growth will not be as fast as the past growth. What is a reasonable valuation for this kind of company? The company is transiting into a different phase. It was fast growing, now it becomes not that fast growing. So the stock will have some difficult times until it adjusts to reasonable valuation for slower growing phase. I think at current valuation, it seems to be okay. The valuation seems to be okay, and the company financial situation seems to be okay too. I think it's worth looking into it at this point, at this kind of valuation. Okay. SML. Okay, ASML. We all know this company, which makes semiconductor equipment for companies like Taiwan Semiconductors. I think it's a very competitive company. They do have good economic moat there, and yeah, of course, it's heavily relying on the semiconductor industry. Their customers are just a few customers. They only have a few customers which they heavily rely on. But I think the risk is small at this point. Valuation seems to be okay, acceptable. I think it has a strong economic moat than maybe stronger than NVIDIA. Okay, and WCP on TSM. We never tried TSM stocks. Okay, let's take a look. TSX stocks, the white cap resources. What does this do? Let's take a look. Let's take a look. Yeah, Canada was, and of course, when Canada, there are lots of companies that are based on natural resources. This seems to be one of those companies developing holding interest in petroleum, natural gas, property, and assets. Okay, seems it's a industry, it's an investing company that hold interest in those assets, in hard assets. Okay, let's take a look. So for this kind of company, probably we should heavily rely on the book value. And yeah, it's cyclical. Of course, the reason is because the prices for the commodities they hold are cyclical, are very cyclical. That's why it's cyclical, and it's. I personally don't like to invest in these companies because it's too asset heavy and too much rely on the commodity prices. And I like asset light companies, like the return on invested capital will be high. But for this kind of company, uh, it's so cyclical. It's so hard to predict. So I don't know. Sorry, I cannot help much on this one. Okay, Dominic is asking, do you plan to add position sizing decisions for tools? Yes, we would plan to add a portfolio optimization tool. Yeah, we do. We have that in plan. Take some time. Okay, Rafael is asking, today is a Liberation Day or Tariff Day. Funds company have all come down by at least 10%. Which funds among the funds company that best alpha? And okay, that's some good companies listed there. Personally, I like Microsoft the most. I think Microsoft has the strongest moat, and it will benefit more from the AI innovation. And if you look at all these companies, Microsoft has, I think, most consistent growth and the longest history. I remember 20 some years ago, during the dot-com bubble, Microsoft was the second largest company by market cap. And today, I think it's still the second, if not first, it'd be the second largest company in terms of the market cap. Yeah, today it's the second one, only behind Apple. So 20 some years ago, I don't remember which one was the first one, either GE or some company had the largest market cap, and Microsoft was the second. Today, Apple is the largest company, but Microsoft is again the second. So, there's a reason for it, because Microsoft has a strong economic moat. And yeah, we all use their product, and we don't have anything to replace it. Okay, that's my opinion. Okay, Tencent. Nate is asking Tencent. Tencent is a company that I think let's talk about this one. It's a Chinese or giant internet company which has a tool, which has an app called WeChat. Almost every Chinese using WeChat. I use it a lot too. Yeah, WeChat. The growth has been slowing down, but I think the valuation is reasonable. It's more is acceptable. And I faced some headwinds because of regulations in China, but in China, the political situation can be unpredictable. I I used to invest in Chinese companies, but not in last few years. I decided not to invest in it anymore. So that's my thoughts. Okay, I think we took a look at Evolution AB already. Any other company that I'm looking at? Um, I feel that at this point, I don't have much. I don't find good ideas. I found that most of the stocks I like are overvalued or uh, still not undervalued enough. So I have not buying any new stocks for quite a long time. Last year, I bought the largest position about was Brown Brown. It's an insurance agency company. It runs insurance agencies. And the company grow mid-teen digits every year through acquisitions and through organic growth. I bought this, I think, about a year ago. Has been doing really well. It's up about 50% since I bought. Um, Even this year, we had a market correction, and stock still went up 23%. But if you look at valuation now, I don't like the current valuation. Valuation P ratio is 36, and we mark it as significantly overvalued. I never sold any, but if you ask me if I want to buy it at this point, I will not. I think its valuation is high. And that's that's my largest purchase last year. This year, I have not bought any stocks. And that's where we are with the market. Okay. And that's what I have. I think, okay, one last one thought. KNSL. KNSL. Kensel Capital Group. Don't know about this company, never heard of it. Let's take a look. What does it do? It's okay, it's an insurance holding company. Okay, well, Brown Brown is an insurance agency company, so it's not an insurance company; it's an agency. And the Ken's Group, let's take a look. It's a, okay, it's an insurance company. This Kensel is an insurance company, so it's different from Brown Brown, although it's related. Kensel is an insurance company inside of insurance agency. A specialty insurance on health and healthcare, life science, professional and public. Okay, yeah, it's a insurance on life and on properties. Yeah, let's take a look. I think looks. If I just take a look at here, I think it looks pretty good. It's reasonably profitable. The growth is good. Valuation is reasonable. Valuation is good. Yeah, I would say that if I just take a look, I want just take this look. I think it looks not bad. Of course, for insurance companies, we know that um, the combined ratio is the most important indicator. And the combined ratio needs to be less than 100%. And it's even better if the combined ratio is expanding. So that's about insurance company. Do I still use any quantitative tools to develop your portfolio? I'm not sure what this means. I don't use any technical tools. All the tools I use are on Guru Focus. The things I use the most is Screener. I use 30-year financials a lot. I look at our valuation a lot, using our interactive chart a lot. That's almost everything I use. Adobe. Okay, where this is the last one I will look as we are running out of time. Adobe. Yeah, we use our tools. Actually, the number looks really good. If you look at the indicator, numbers looking really good. Of course, we all know the reason why the stock has been going down. The stock has been going down due to the threat of AI, because it seems like lots of tools we use to do the pay photos or videos, it can be done by AI automatically. It seems to be like that. I think that's a real threat. I do think so. And it's a threat to company like Adobe or to company like Google. I do think so. And yeah, that's what I think. Thank you all, and hope to see you again next month. Next month, the meeting will be on May 7th. It's again same time, May 7th. See you all next month, and hope to see you again next month. Thank you all very much.